Pressure is mounting on the government to increase revenue sources to ensure the budget is financed aptly without incurring further and unnecessary debt, which currently stands at 2 trillion shillings. Calls for wage increment need to fund development projects, and financing devolved governments are just among factors that contribute to budgetary constraints on the government side. Tax revenues are still the biggest source of budget funding. According to the World Bank report titled Public Expenditure Review, in the financial year 2013-2014, domestic taxes, including agency revenues, made up 72% of government revenues, driven by introduction of Railway Development Levy, excise duty on financial services, and reforming the VAT law, while international trade made up 28% of revenues. Income tax is still the biggest contributor of revenue at 50%, followed by consumption taxes at 25.5%. On the other hand, Kenya's tax base is still not wide enough to ensure the taxman gets what is due. Of the 22.2 million working Kenyans, only a few manage to pay their taxes. KRA mainly relies heavily on the larger taxpayers, who are just 1,138 or 0.34% of all registered businesses to generate 7% of the total revenue collected. The World Bank attributes this disparity to complicated tax systems, low tax morale among Kenyans, informality within the economy, and service or compliance strategies by KRA focused on larger taxpayers. KRA has also been on an aggressive front deploying electronic tax payment systems such as iTax, which it hopes would help improve compliance and ratio from the current 51% to 85%. According to the report, withholding tax has also dropped to 1.1% due to delayed payments to suppliers. The World Bank is advising the government to reduce tax expenditure, remove some tax incentives as this is not a top priority for investors, enhance tax administration, and ensure policy consistency. Ronald Willie, News Our Business.